It's a dire warning. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the government warns of an impending bubble burst, telling investors they need to sell now. I'll show you why the government thinks we're in a bubble, and more importantly, why they may be the ones that pop it. But before we get to that, I want to take a look at what's driving the markets today and an update on what's going on with the yen carry trade. Now, let's head over to Bloomberg, where he picked today's story up with a headline. It stocks in the week with a whimper after days of drama, and this is actually a shock to many investors who have been eagerly buying the dip every day since Tuesday, despite the fact that we're seeing speculators getting flushed out of their trades, being forced to sell. But what the problem here is that dip buyers have gotten used to the fact that once the market settles down, it just rockets higher. But today it's not. Let's take a look at why. As the S&P wavered on Friday and was on track for a fourth straight week of losses, the longest losing stretch in almost a year. And while equities rallied on Thursday after data showed the labor market is not collapsing, many investors continue to exercise caution, but yet still bought the dip after a meltdown at the start of the week. And one of the reasons we're not seeing the market drive higher like we usually do has everything to do with the fact that leverage is getting flushed out. Because when we look at the yen carry trade, what was happening is people were borrowing money at very low interest rates and using leverage to buy risk assets. Well, as you're about to see, the yen carry trade is about gone, and with that, the leverage that continued to pump equity markets higher, suggesting we may be at a near-term peak now that everybody is in. And yet the yen unwind to take many months, indicating that perhaps things are going to get worse, according to BNY, as it's going to be a while before it hits fair value. But one thing that continues to head higher is the trading accounts for our subscribers. You know, we have our CTA Timer Pro. We just put up some big numbers yesterday. One of our trades on one of our reports was up 4.5% yesterday, and we got a couple trades which are taking off like rockets right now. Now, maybe you want to beat the machines, and we show you how to do that, because when they get in deep short positions and price moves against them, well, the machines that trade hundreds of billions of dollars, well, they need to buy, and we flag that across major equity, bond, currency, and commodity markets. But maybe you like to trade momentum. We do that too, but the difference is we look at it over longer time scales. In addition, we aggregate all those technical signals together, but we run a proprietary overlay to smooth it all out, and when momentum shifts, it flags on our report. And here's the best part. You can get the daily report, whichever one you want to sign up for, or maybe both. You get every tradable signal. I go through every one of the trades and tell you which ones I think are the best. I issue a stop loss level. I track the trades and returns. That's right, all the good ones and even the bad ones. And we give you a weekly update on stop loss levels. And here's the best part. There are links in the description below for a 30-day free trial. Despite the fact that U.S. equity markets are on the hinge of perhaps another leg down, there are big opportunities other places in the market. Be a subscriber, start making money, start taking control. Links in the description below, because investors are still too bearish on the yen and short positions will continue to be slashed. This is an issue, which means there's more leverage to unwind here, and that's a risk to the U.S. equity markets. And something I said that would happen over Tuesday, Wednesday, and Thursday is you'll see these speculators have to be forcibly unwind their positions. But one thing that U.S. investors did is they greased the wheels of the market by plunging money in, allowing these speculators to at least find someone to sell their holdings into and thus close out some of those positions. The problem now we're facing is it may be getting worse, and central banks could be the ones that pop this bubble. Analysis shows the yen is too cheap at its current level of 147, and its fair value, get this, could be as low as 100. And if that's true, then that means there's going to be a lot more pain coming, because what we're going to see is this carry trade continue to get unwound, and we're going to see leverage trades and forced selling across major markets. And they expect the pain for yen shorts to remain in play for weeks, if not months ahead, according to BNY. Further risk reduction elections are going to follow, and August will continue to be highly volatile month at a time when we already know this is the #1 month out of the year where we see selling, we see flows out of the market. We've now seen hedge funds, retail investors, everybody who wants to buy the dip, who believes stocks are cheap, has come flooding in. Now the problem is the seasonal flows are still here, and in a matter of a month, actually less than a month, the corporate share buyback blackout window is back, and that is a big problem. But let's take a look at how, of course, we could see the problem with interest rates and the Fed popping the yen carry trade as we now look at the Japanese yen to US dollar spot exchange rate in red. And what BNY says, it could get down to 100, which where is indicated by that dotted green line, suggesting there may be a massive amount of leverage being built up here over the post-pandemic cycle. But one thing we can note is there are some times when the Fed cuts rate, the yen goes higher initially, but usually it trends lower. Here we can go back into the mid-80s. We see the Fed cutting rates and the Japanese yen to dollar spot exchange rate goes down. We see it here again going into the early 90s. The Fed's cutting, the yen rises, and then the yen falls, and then it comes down. You see that effect here again in the late 90s. Once again, early 2000, you find out during the global financial crisis, and even a little bit here early on before the pandemic hit. The question is, if we see the yen rally here, and that means the exchange rate, of course, goes down in value, that means there's a lot of leverage sitting in this market that is going to get unwound in a major way. And the short positions were accumulated over the past years when traders took advantage of the BOJ's ultra-loose monetary policy to borrow the yen and buy higher-yielding assets elsewhere. The strategy helped to push the currency to its weakest since the 1980s and prompted official intervention to prop it up in July. Now, many people believe that the yen is actually going to continue to fall in value, and this could have really serious issues for the U.S. equity market. As we now turn to the NASDAQ 100, that we're going to overlay against that yen to dollar spot rate, still shown in red, and we can see sometimes here, like in the global financial crisis, where there was perhaps some leverage built up on this carry trade, and what you see is the yen rising in value, and that again adds to the downward trend of the NASDAQ and the broad U.S. equity market. We perhaps see that effect again, and this is more likely that we saw the carry trade built up during this period, where you see again the yen rising and the U.S. equity market stumbling. But look now where we probably saw a lot more leverage, because the longer these trades go on, what happens is the margins get thinner and thinner. So they're borrowing less and less money because they just don't have the equity to borrow it. And then what happens, you have to take a lot of leverage to get the net return you want. And look what happens here. You see the yen kind of rising in value. What happens? U.S. equity markets choke. You see it happen again and now a third time, suggesting that if the yen were to rally to 100, well, it could flush out a massive amount of speculation, and that could send U.S. stocks nosediving. But as we turn to the government now warning investors about the bubble bursting and it's time to sell, let's head over to China, where the PBOC studies plan to narrow the rate corridor and warns over bond risk, telling people, look, you need to sell your bonds because there is a massive bubble here. The reality is, the question we're going to ask, is there indeed a bubble in bonds? Well, the PBOC says yes, but what do you think? Weigh in the comments. Do you think rates are going higher or lower now? Because the People's Bank of China is considering how to reasonably narrow the corridor, adjusting to a quarterly monetary policy report just today. A tighter band would help the PBOC steer market rates so they fluctuate around a level it targets. So rather than have a wider band, they're going to narrow it and try to keep rates within that corridor. That's what they're suggesting here, because just like, of course, the Bank of Japan wanted the yen to go higher, PBOC, well, they want the yuan to go higher as well. Of course, we know there's carry trade against the yuan as well, and that could end up in disaster. The PBOC last month introduced a new mechanism aimed at narrowing the rate corridor by preparing to conduct overnight bond repurchase or reverse repo operations. And though it is yet to use the tool, such a move would narrow China's rate corridor from about 230 basis points to 70. Now, what the issue here is, what the PBOC can do is they can borrow bonds from the banks and then sell them on the market. See, what the PBOC wants is to drive long-term interest rates up, and they're telling everybody, look, investors, speculators, banks, anyone that's holding long-term Chinese debt, it's a bubble and it's going to burst. And the problem is they're the ones who are looking to do it. The central bank also used the report on Friday to sound warnings about the risks of what it considers a bond market bubble after an unprecedented rally since yields so low that it could endanger financial stability and pressure the yuan. Now let's talk about long-term interest rates. And it doesn't matter whether it's in the US or China or anywhere else in the world, long-term interest rates are a function of inflation and growth expectations. Now we know inflation in China is very weak, but when you see yields also going down as inflation remains weak, it means the market is pricing in lower and lower growth. And how do you get growth to kick off in a debt-based economy? Well, generally higher interest rates don't spur people to borrow and spend, but lower interest rates do. Now, the issue here is a reason the PBOC does not want lower interest rates. The reason Beijing doesn't either is because if there is an interest rate mismatch between, of course, what's going on in China and, say, the United States, the money will flow out of China to find the highest possible interest rate. And as money flows out, well, that means the yuan goes down. What you're seeing here is the PBOC trying to pop this bubble, warning people, just like with what happened in Japan, except if they do, could have the same implications, sending U.S. equity markets and global markets crashing because, well, there happens to be a yuan carry trade in addition to the yen. The central bank, some wealth management products, that is, especially those based on bonds, have achieved better returns due to their leverage, according to the PBOC. And that's the issue here, is they're saying not only interest rates too low, but there's too much leverage in the system, something that we have noted is just everywhere. It said the approach carries a lot of interest rate risk and can lead to losses if yields rise sharply, which they are looking to do. And this is in particular because consumer inflation in China now picks up, but demand concerns persist. So yes, you can see times when inflation pops up, but if it doesn't match with increased demand, well, then what you'll see is inflation come down. And yes, sometimes you get some one-off issues, which is exactly what's happening in China, because China's economy is battling deflationary pressures, with one measure showing the longest streak of falling consumer prices since 1999. Now, we saw a month-over-month increase of 0.5% in their monthly report, but this had largely to do with pork prices going higher. And yet weak consumption and investment demand have led to intense price wars in sectors including electric vehicles and solar, hurting companies' profits and making consumers even more inclined to delay purchases as they expect costs to keep dropping. And that is a problem because in a debt-based economy, you need consumption to drive demand. And if people believe the prices are going to fall, well, that means they're going to spend less, and that's going to become a self-fulfilling prophecy. So despite the fact that China saw inflation jump to 0.5% month over month due to rising pork prices, what that's going to do is take spending away from other places, as of course Chinese consumers continue to demand pork at any price. And data on Friday also showed factory gate prices extending a deflationary run that began in 2022. The producer price index declined 0.8% from a year earlier, in line with a drop in June. And so it's no surprise that the yuan is weakening in value because demand is not there. And you look at what actually drives demand for currencies, it's global trade, it's commerce, it's people spending money and needing currency. And right now, there's no sign of that in China. But what it does mean, of course, is U.S. consumer prices likely to head lower, and we're going to find out more on that next week when we get the latest consumer price index from the Bureau of Labor Statistics. But here you can see import prices from China remain in negative territory, and when that happens, of course, you can look back through history and see that it puts downward pressure on U.S. consumer prices at a time when demand from U.S. consumers is starting to wane. No different than what's going on in China or Europe or anywhere else in the world. And reviving domestic demand is increasingly important as exports, a rare bright spot in the economy this year, unexpectedly slowed in July, signaling a cooling of global demand that is impairing Beijing's goal of around 5% growth for 2024, which we think is highly unlikely. But you can see when the global economy is running and there's demand from consumers, then what you should see is the world's largest exporter, that being China, should have plenty of new business. The factories should be running full strength ahead, and they should be driving exports. Right now, they do not see that global demand, and the only exports China is trying to push are those before any tariffs come into play. But the problem is, where they send those goods, there just happens to be no demand. And there has just everything to do with, of course, U.S. consumers not having money to spend as we look at total compensation growth in the U.S. continuing to slow down. As a result, as we look at average hourly earnings, which continues to slow down, a production of non-supervisory employees multiplied by average weekly hours, which also continues to decline. And that indicates, of course, total compensation growth shown in blue on a year-over-year rate of change. We look at import price index, and as consumers in the U.S. see their total compensation growth slow, well, that means their ability to spend money and consume goes down, and demand for cheap Chinese goods also goes with it. And you can see that effect right now. So any hope that there's going to be a rebound in exports in China and a resumption of the yuan heading higher, well, fat chance on both of those. The PBOC's got a bigger problem. The question is, are they going to be able to bust the bubble, or are they going to kick off another carry trade disaster just like the Bank of Japan did? But many are hoping in September, which is now just a little over a month away, that the Fed's going to run to the rescue. But that odds of that, I think, are much lower than most think. The Fed's seen rejecting calls for jumbo rate cut in economist survey, but major Wall Street banks, including JP Morgan and Citigroup, are eager to see it and change their calls after last week's job report to predict a half-a-point move next month. More broadly, futures investors responded by pricing a 100 basis point reduction by the end of the year, which I think is more likely, starting with a 50 basis cut next month. Now, we know Fed Chair Powell likely wanted to cut this last month, couldn't do it, setting up September to be the most likely case. But will we get the full 50 or just a quarter? Well, a lot of it will have to do on the U.S. economy, and more importantly, the labor market. But there's yet another indicator. We'll look at that here in a moment, as the consensus among economists was that the Fed would opt for a smaller quarter-point move at meetings in September, November, and December, and the first quarter of 2025. The 51 economists were surveyed between August 6th and 8th in the wake of a global market sell-off, indicating that they didn't believe that the decline in equity prices would drive a move of the Fed. And normally it doesn't, but there's one indicator that does, and that is two-year Treasury yields. And at the moment, they are trying to tell the Fed that, yes, it's time to cut rates. The question is, where will two-year yields be by the time we get to the next Fed meeting a month from now? Because keep in mind, seasonally, this is a poor month for interest rates in terms of they tend to go up between August and September. If we see two-year yields go back up, it could put the Fed on ice once again, or maybe just get that smaller quarter basis point cut that the banks don't think. But if China has their way, look for them to pop the bubble. I don't think it happens. In the meantime, the more likely path right now for the U.S. equity market seems to be lower, not higher. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.